Good morning, everybody, and welcome to our show, Mortgage Rates Today. We have an average 30-year fixed interest rate for 6.47%, and today's date is September 21st, 2022. Holy moly, that interest rate has gone up, guys, and we'll dive right into that rate. But I'm super excited and stoked today because I have a great friend of mine, but also an amazing real estate agent, specifically here in San Diego, that where he markets. But he's a top 1% agent in our area. He's an absolute expert at knowing real estate, and Noah will be taking us shopping somewhere here in San Diego today. So Noah, thank you so much for being here, man.
Thanks for having me on the show, Garrett. Excited to be here and appreciate the opportunity.
Yeah, absolutely. Let's dive right into the rate here and see how we can put it to the test on your property.
Sound.
All right, so before we get to your beautiful home, we get to look at this 5-year snapshot graph, right? So today's rate is 6.4%, 6.47, and you can see over a 5-year period of time, right? We're at the top of our mark right now as of where we've been in the last 5 years. And in that peak that we saw right around June time, we're kind of surpassed that now. And there's so many things at play that are making up this interest rate. And remember, this isn't an interest rate, guys, that we're quoting. This is an interest rate that is derived from Mortgage News Daily. You can Google this. You can be an agent, a lender, a borrower, anybody can Google Mortgage News Daily, see the average 30-year fixed interest rate that's being sold across all the banks in the nation. And so that's where we derive this number from. So your specific qualification, how much you put down, your FICO score will all kind of determine this interest rate. But this is the average that's being sold right now. And as you can tell, it's kind of high. And the reason, right, is because we have so many things at play, but the real driver of this is inflation in our market. And when we have so much inflation, rates have to go up because we have the same amount of goods and services, but now we have more dollars chasing those goods. So what we should anticipate, right, with the Fed meeting here today, rates are going to continue to move up and down through this market based on all economic policy and all of the different outliers that are happening in our world. Energy crisis, supply chain crisis, world issues with other countries like Russia. We're just going to see a lot of up and down in our market because people don't know what to do with their money. And before, America used to be the safe haven. Bring all your money over to America, but now we're dealing with a lot of inflation here. So that's why we're going up and down in this market. So today's going to be a really big day on what the Fed decides to do with interest rate. And if they take it higher than where we anticipate it, that'll be good for the overall economy because it'll get us through the recession much faster. But one of the questions we get asked all the time, and that's why we have our expert Noah here, is what's the mindset of buyers? Because we're starting to see a shift in the marketplace with higher interest rates, values staying high. So it's becoming a little bit tighter of an affordability. So Noah, you're dealing with clients on the list side, on the buy side all the time. What are you hearing from their mindset on a daily basis?
Sure. So the buyers are really divided into two groups. If they've been searching kind of pre-May, June, they probably have a lot of regrets. They had an opportunity at a really low interest rate. They were probably in that crazy market of bidding wars, and maybe they didn't go high enough to get a property. So looking back, they say, wow, I could have got something lower price at a better rate, and I've missed that window. They're in a tough situation. It's hard for them to kind of recalibrate their new budget and price point and affordability. You're out there looking at homes at 1.2, 1.3 million. Then your lender is to dial you back in and say, hey, rates have changed. You need to now reassess at $1 million or 1.1. Still a healthy price point with options, but after you've seen that higher tier and now you have to dial it back and see smaller homes or older homes or homes that aren't quite as updated, it's tough. It's a tough psychological shift. So that group of buyers, they're struggling. And then the next wave of buyers are kind of these post change in rates that occurred around June, where we had the big first jump. Their attitude's a little more straightforward. They weren't shopping in that old market where they could have had that low interest rate. So they're reaching out saying, hey, what am I approved for? Okay, great. What's the rate today? Here's what I can buy. Let's go house hunt. The only difference with that second group of buyers is they're hearing the news about the market changing. They're seeing the media stories. So they're coming in a little more, kind of elbows being thrown and wanting to write some more balanced offers and actually have contingencies in their offers and maybe even do a request for repair, God forbid. So they're in a different state. But I think that next wave of buyers, as they get ready and they get out there, it's going to bring some pickup back to the market.
Yeah. So with the slowdown of kind of the economy of what we're feeling, interest rates going up, values still holding their value, it's that mindset of the buyer going, I was approved for this before. I want to be back to that same level, and now I'm unable to get there because of where rates have gone. So in January just this year, right, we had rates that were 3% lower than where they currently are on a typical $600,000 loan. That's over $1,000 in your monthly payment difference. So it definitely affects that affordability. And yeah, let's kind of hop right into it and see your property here that you're going to show us. And where is it located?
Sure. We're going to head down to East Lake in Chula Vista near Otay Mesa. This is a part of San Diego where 2005 build for a detached house around $800K. So let's take a look.
Perfect. Let's hop right in. Very cool.
So this is 1575 Voyage Drive. What's unique about East Lake and Otay Ranch, this is what we call a master plan community, meaning, 25, 30 years ago, there was nothing there. It was rolling hills. And then they came in and they developed and put in all the infrastructure and the schools and fire and shopping and homes. So it's a pocket of San Diego where you can get newer products. And I kind of label that as like 2000 and newer. And this is what I would call entry level detached. So we're around $800K for a traditional 3-bedroom, 2-bath home. Almost everything down there is located in HOA communities. So you do have that fee. And then some of the communities, a lot of them have a Melrose tax as well. What's unique about Voyage, you'll see in a moment some of the pictures of the backyard. And when you're in this entry-level price point down in East Lake and in Otay Ranch area, a lot of the detached, their yard is more like a back patio or side patio on like these 0 lot line setups. So to have a kind of traditional, normal size backyard is hard to find. So this home went up last week. We had open houses on Saturday and Sunday. We had quite a bit of activity, which is a little bit of news for this market and this slowdown. And 2 offers in. We actually just accepted an offer yesterday, and we're opening up escrow. So, you hear all these stories about these home sittings and homes sitting on the market and the price reductions. It's not every property. So I definitely, with my buyers, spend a lot of time training them that we can't have that attitude on everything that comes up. Yes, some homes will be overpriced. They will sit, they will do reductions, but not all of them. So you need to be able to tell which ones are going to go that directions and which ones are going to have the immediate interest and attraction. And we're in contract on this one just over list price. So this had a more typical time frame and lifespan of the old market. So some of that stuff is still occurring today.
Yeah, very cool. Very cool. I like that. I like that backyard a lot, much more than I anticipated too. Like you said, it's very large and spacious.
Yeah, it's got room. They got a swing set, a couple seating areas, so a lot of options to make a nice space out there.
Well, very cool. I know you're representing it from the seller side. So let's say if we were on the buyer side now, right? And let's pretend a buyer was able to capture this property at list price of $799,900. And remember, we always go over a 10% down conforming loan option. And we're assuming a FICO score anywhere about 740 or greater. And this is the rate that's derived from mortgagenewsdaily.com. And anybody can go look at this rate. But if they were able to capture it at $799,000, we're putting 10% down. That's $79,900, leaving our total loan amount, right, at $719,910. With our mortgage rate of 6.47%, that's going to leave you with a principal and interest payment of $4,536. And remember, that is just the mortgage payment. So that's the interest rate on the 719 loan. All right. Then there's going to be additional costs per month that are tied to that mortgage payment, like property taxes, which you see here, real estate taxes. Now, Noah did mention earlier with communities that are somewhat newer like this, that have a very cleaned up community area, might have other certain amenities or parks or green areas, you're going to have a Mello-Roos fee. And so a Mello-Roos fee is where you have a larger tax liability. And that's why you see on this property, it's about a 1.5% overall tax. And you'll see that your tax payment per month is going to be about $1,000 on this property here. Homeowners insurance, we're going to be about 0.23%. Remember, homeowners insurance or hazard insurance is just the same thing we got to do with our vehicle. We got to go get auto insurance to protect our liability from personal liability, but theft of property, damage, fire, all of that. So we got to get homeowners insurance. And that's about 0.23% when we have a 10% down option. And then your mortgage insurance, right? This is a conforming option that's less than 20% down. And you're at less than 20% down, you're always going to have a form of mortgage insurance. And being at a 740 FICO score or greater, you're going to find that somewhere around 0.21, maybe be lower some days, maybe be a little bit higher. But this is the average of about 140 per month. And then our HOA fee is very small on this property because we also have that Mello-Roos fee that's added to keeping that community tied in and upkept. So this small HOA fee is $105, and your overall payment is going to be $5,934. So in summary, right, if Noah's buyer was able to capture this at list price at 10% down, we're going to have a loan amount of $719. Your mortgage interest rate of today would be 6.47%, and our estimated all-in mortgage cost and housing payment for this property would be $5,934. So still somewhat affordable, but it is higher, right, than where we've been in the past. And so what we're starting to see happen in this current economy, like Noah just mentioned, there's properties that are sitting a little bit longer, but there's not always properties that are going to sit longer because we still have more demand in San Diego than we have supply available, right? And that's what we're seeing still hold true to this day, that rates are pushing people out of our market, but there are still plenty of people that are still able to afford these properties, and values are going to stay high because home ownership is in high demand right now. It's not as a scary thought as we've anticipated, because rates, we do see a future of them coming down. So within 6 months, within 12 months, we should be able to see interest rates slowly start creeping down because of the recession. And the values, that Noah's going to be showing around San Diego should hold true to their value. Do you kind of see that same piece, Noah, happening?
Yeah, I do. I mean, I think, it's a turbulent time because we're moving fast. As you mentioned, that's a huge jump in interest rates from the beginning part of this year to now. And I feel like in the old world, things didn't move that quickly. The information's passed so freely in today's world that we have these faster bursts of change. So people are wrapping their head around it. But I also tell my buyers, I say, look, the last couple of years, there were no deals. No buyer bought a place going, oh, I got that one at a steal. They were just happy to get a place. They know they overpaid. The money was cheap to borrow, so they were fine getting in these bidding wars and going higher. And it was only months after moving in do they see the next house across the street go up for sale 100,000 higher, and it's smaller in size. Do they finally feel good, like, okay, good, the market's still going the right direction? So when everyone's on the same page and the market's doing this or the market's doing this, it's hard to find a deal because everyone's in line. When the market's doing this and we're not all quite sure, that's a great buying climate because everyone has a different sense of direction. And if you find the right property where you've got a seller that just says, I think we're going in the wrong direction, I want to get out, that could end up being a great buy. So it's in these markets that I think the deals can be had, whereas in the last 2 years, there weren't deals. You were just buying on this trajectory, and you knew if you got on in time for the ride, you'd get some instant appreciation out of it. So it's interesting times. And then two other quick things on the breakdown. So this area has Mello-Roos tax, and on the property tax bills, you can print these out. And next to each Mello-Roos tax is a contact number to find out when they expire. So they run generally 20 to 35 years. Some can be a little longer. So when I'm working with clients in an area that was built early 2000s, we might have some of these Mello-Roos taxes falling off soon. So super important for buyers to know that, because if they only have 7-8 years left of some tax and it's going to go away and fall off the property tax bill, that's important for them to factor in. On the Mello-Roos tax, when you pull up the property tax bills, some of these are community fees and maintenance fees. Those don't go away. So it's important buyers and agents understand which ones could fall off and when. And then I always warn my buyers, when a Mello-Roos tax is expiring, it doesn't mean that that tax is completely going away. That specific tax might fall off, but if that tax was for schools or fire or police, you may see the community put together a bond that they want everyone to vote on to, expand the school or build the other fire stations. So you could have new taxes come in when these Mello-Roos fall off, but it's important to note. And then one other unique thing that I talked to you about a few weeks ago, my clients on this were military sellers, and they had a VA loan. And as you know, a VA loan can be assumable. So the trick on this one, they had a really good rate. 2.8 was their 30-year fixed VA loan. And it was 512,000 was their balance. Wow. So the catch is you need to try and find a VA buyer that can assume that loan at 512 and then either secure additional financing for that gap between purchase price and the current loan amount, or if it's a VA buyer that's got some savings, they could bring 300 some down to the table as a down payment and take over that loan. So we definitely had a few agents and buyers call about that and to see if they could work the numbers and assume that 2.8, because obviously in this interest rate climate, that's an awesome loan to take over.
Were you guys able to do that on this one, or just get a?
We weren't. We had one VA. An agent had one VA buyer that did have the 300K down. So he almost had it all. So they were trying to structure some other loan to get attached to the property with the down payment he had. They didn't get it all together in time. This other good offer came in, so my sellers wanted to move forward with them. But we did get a lot of calls on it because obviously, if the circumstances are right, it would work better in a market where the gap between the loan and the price wasn't so big, and then other buyers could kind of bridge the difference. But as you know, to take over a 500 some K VA loan, then find financing for the remainder with a little bit of down payment, not the easiest task, but it is an interesting feature of these VA loans.
Yeah, no, 100%. And, like we always mentioned, it's a time of, we always bring up, if you can afford to buy right now, it's never a wrong time to buy. And it's just deals with your personal journey, where you're currently at with your home ownership journey. Do you want to stay in this property long-term? Do you want to stay in this property to make a profit potentially by flipping it? Those don't really exist in our market in this current environment. But if you're looking at home ownership for a long-term, we all have to live in a property. We all have to have a place. So if you're going to be here for a while, to purchase a property, if you can afford that monthly payment, then it's always going to benefit you as opposed to paying off somebody else's mortgage, right? By being a renter.
Very true.
So it is tough in this environment. And like you mentioned, I do believe values will continue to hold through, all these ups and down cycles, because we showed the demand for home ownership here in San Diego. So we always like to wrap up things in our show by saying, all right, last words, Noah, you are our expert here in San Diego. What do you got for us here for the last bit?
Well, I think it's, we're all kind of waiting on the news today. We know that we've got some economic factors that are still a little bit out of control with inflation, and we need to see some more consistent numbers before we finally rein in these rates and we see, what range we're going to be operating in moving forward. And, they pick apart every movement and every word of the Fed chair to kind of dive in. And these markets don't trade or don't move off today's information. It's always forward looking. So I think last go around, he mentioned something about like pain to the households, and the media ran with that. So I'm going to be watching today. I'm going to see if he wipes his nose with his right hand or his left hand, and that will tell me which direction we're headed.
Yeah, absolutely. Yeah, if you're in this industry, my last words to the same piece. It's a very important meeting today. But if you're, real estate agent or lender, and you think that you know exactly where these rates are potentially moving, we don't know. There's so much economic. We know that the overall trend should be lower, but with the short term right now, tomorrow could it be better? Tomorrow could it be worse? We have energy crisis across the entire world. We have war potentially still at rise. We have supply chain issues. We have our own inflation that the Fed is going to have to combat here today. So it could go in multiple directions on a daily basis, but know that the overall trend, right, is that rates should be coming down. So we all appreciate you very much for joining our show, Mortgage Rates Today. tune in and subscribe, please, and tune in tomorrow morning. And Noah, man, thank you so much for being on here. Always a pleasure. And I know we'll be talking again soon.
Thanks for having me. Appreciate it.